Hello, welcome to another episode of World of Oil Derivatives. I'm the CEO of Onyx Capital Group. I'm joined today with Vincent Wu and Audrey Byrne. So a quick reminder before we get started, this is available on YouTube if you prefer to watch us in 3D. Right, let's get straight into it. Guys, Audrey, what have you been working on this week? What are you going to talk about in this podcast?
Yeah, so I went down a rabbit hole of AI generated images this week, and that kind of brought me on to, thinking a little bit about, trading using algorithms. So I was at eWorld recently, and the power markets are kind of ahead of the game with this. They use this a lot to regulate the market, and obviously there are players in the oil and swaps market using algos as well, but kind of just, in terms of AI generating images and then these algorithms reacting to it, just kind of having a discussion around this and maybe getting people's feedback on that as well would be great.
Cool. And Vincent?
Today I would be discussing about the OPEC cuts and the aftermath of the market reaction and all of that. So just a follow up from previous weeks.
That was a very school person answer. Thank you. Look forward to it. So to start with though, let's do what we usually do, which is to summarize kind of the week's price action, what's been going on in oil with derivatives and the kind of key headlines. So Audrey, do you want to start us off? What's been happening in the last week?
Yeah, so since the OPEC cut, we saw prices hit kind of a max $78-$20 per barrel level, and really they've relaxed now down to the low 70s this week. Everyone's kind of done and dusted with that news, kind of all priced in, and everyone's looking forward now to the Federal Reserve's meeting tomorrow. The general consensus is, they're not going to up rates again, but we're going to have US consumer data coming out this afternoon. So there really is no set and done will they, won't they tomorrow. It really does depend on this today. If the Fed believes that the inflation isn't coming down at a fast enough rate, there's nothing stopping them from hiking by another quarter base point. In terms of CFTC this week, so I kind of think as expected, longs in manage my money positions increased. Well, I find really interesting though, so we did see the shorts kind of exit again for a 4 consecutive week, but the rate at which they're doing this now has slowed. So I think tomorrow's
longs exiting.
Longs increasing, which would kind of expect. We were expecting a cut. We'd expect those longs to come in, and we'd expect the shorts to exit, but they were just at a much more muted level compared to what we had been seeing in the previous 3 weeks. So I think tomorrow is going to be the kind of the game changer this week. If they do or hike interest rates, I think we might see more of those shorts coming back into the market in the next CFTC report. Although the problem with that is actually it probably won't be seen till next week because the CFTC data lags by so much. I think this Friday's CFTC report is probably going to be a bit more kind of lackluster, not much changes. But next week's I think we'll see the reaction to what happens tomorrow.
Yeah, I think on that point, so you're focusing on the speculators, the managed money speculators on Brent reacting to kind of macro headlines. Yeah. So, yeah, that's definitely been the case, at least, I would say, for the majority of this year. Vincent, would you agree? Like the macro kind of first 6 months of the year has been leading, right?
Definitely a lot of recession fears. Bearish sentiment that's just been dominating investor sentiment as well. So but
which way around would you call it? Like justifying the bearish move or leading people's positioning?
I would say both.
Yeah.
It has sort of a circular effect. So people were talking about China's post-pandemic recovery, but also the fact that recently the data showing that the rebound hasn't been as strong as people might have expected, but also at the same time a lot of recession fears, interest rates, inflation, and all of that. It seems like the world was quite optimistic about the post-COVID rebound, but it's definitely been a rough recovery, that's for sure. So,
but you've got a buying or selling binary option for every speculative trader, and the oil trading market, professional oil trading market, like the majors and the trade houses, on balance they're bullish, right? Or have been bullish. So they've been buying on a supply and demand call for second half. That's the theme. And but then the managed money is probably more macro recession fears. That's fair to say, right? Yeah.
Yes.
So I mentioned all that because yesterday, as we're heading up to I was going to say the market sold off despite the S&P rallying, hitting like an all-time high, if I'm not mistaken, or a 14-month high. So I need to check that. But either way, strength in kind of equity markets, macro markets, oil selling off quite aggressively, like $2.50 per barrel is pretty significant relative to recent moves. So you can't really count macro in the same argument there. So something else was at play. There's some decent volume going through, and it kind of no real headlines to go off the back of. So to me, that's some repositioning is the only real explanation, and or some more producer hedging potentially coming in. But I think from the evidence with the open interest getting lower, I think actually it's these kind of oil traders who had been bullish for this year.
Just taking profit.
I mean, I wouldn't say taking profit because they haven't made money, right?
Yeah.
I'd say there's some bit of taking profit from buying in the low 70s before the cut.
Yeah, at the 78 level.
At the 72, 73 level, back up to 78. Yeah. And then now that we come off again, it's just yet another kind of example of you can't take this, like the cuts aren't having the impact. Yeah. So I think the professional oil trading community, the trade houses and the majors, that to me yesterday would have been the sign. And there was quite a bit of option, like put option activity as well on the buy side. Yeah, that's just how it seemed. So an interesting thing as well is like the media is getting a bit more, just every day it seems to be like more and more like the word sentiments coming in when it used to be so supply and demand. So I think we are kind of just in a new kind of look at markets now. Like the way people talk about markets is different these days. And I think there's been an emphasis on the fact that the Saudi minister is basically going against the world and going against the sentiment. And I think Bloomberg did an article like, oil traders are defying, they're making it about that, right? So basically it's like, sorry, did you want to say something?
No, I'm thinking of actually really good example of something like this in my head.
Go on.
No, did you see the big rally in LSTFEI last week? And everyone was like, oh, what the hell is going on? And actually, it just kind of did a deep dive into the data yesterday, because I was even talking to the trader, and it was like, oh, the seller, started short covering, and everyone panicked, and everyone just started like piling in and buying. Yeah. But actually, you could just see it in the data days before that everyone was actually getting long LST and short FEI. It's all in the data. Like, it wasn't this big, crazy surprise. It was happening for days. No.
Segue, yeah. I mean, that's one of the more niche stuff. You're talking about the propane.
Yeah, but it's the same logic, isn't it?
No, I know, agreed. I'm just saying for listeners, LSTFEI being US propane versus the kind of Asian benchmark propane. So that diff blew out and people started buying it in a panic, you're saying? Or
yeah, so it was just one guy that was constantly selling. He just started buying, reversing that, and everyone just panicked. And obviously freight was coming off really aggressively, so everyone started buying that ARB. And everyone was like, oh, this happened in like a period of a couple of days. But actually, it was like since the 24th of May, you could see those flows coming in on the July LST, those buying flows on that versus, a lot more selling in the FEI in July. So it wasn't this one big move. It really was prime for that rally. And we've seen it time and time again in like other markets. We saw it in like Brent Dubai. And now like it's there in the data. It's not necessarily like the supply demand, because you could argue supply demand with this. You could be like, oh, freight came off, so everyone bought the ARB, and now the ARB's shut, and it's going to be supply demand again. And it does play into it, because obviously there is, because it doesn't make sense, because demand really isn't there in US propane. So it doesn't really make a whole lot of sense for it to rip, and stocks are still building week on week as well. So in that sense, your supply demand doesn't make a whole lot of sense, but your flows can back it up, and your flows provide that logic there.
Yeah. Well, on that point with Brent, that's the thing. Like, it's I think as I say, that the supply and demand argument is like weakening, and then like, but at the same time, the way the media is portraying it, and I think it's important to say the media or the research houses, because we're a very herd market, right? People tend to react to the same things, and they all read the same reports. Yeah, and it seems like it's tight physical market versus bearish sentiment financial market. That's been like the talk in the last few weeks or even months. But I don't know if I agree with that. I agree in the dated Brent report this morning. Yeah. It's like, yeah, fine. You've got a bit of that maybe at the beginning of the year, but the prompt physical, not even cash markets, like just the prompt like 10 to 30 day or even 30 to 60 day physical indications, which is what the derivatives give you, is weak, right? We're struggling to be backwardated in dated Brent. It's obviously a lot of crude as a benchmark in Europe. Low refinery margins, Murban crude, which is like a typical it's a sought after grade in the Middle East, and usually exported to refiners in the Middle East and Asia, is now being arbed into Europe. And it's like, that's quite a lot of bearish indicators in the physical market. So I don't know why everyone's getting so hyped about financial bearish sentiment. It's quite physically bearish too.
As well, yeah.
And I think the physical bullish sentiment is all based on a fantasy story that needs to transpire second half. It's quite a broad term, second half. Second half is right now because we're trading July barrels.
Yeah.
And August is the prompt Brent month future. So the August-September Brent spread is indication of real physical demand for August, which is second half. And that's going into contango. So where is this story? You love it, don't you, Vincent?
They'll change the narrative into the fourth quarter soon. But then it is, well, you could talk about the physical market being tight, but then, you know, different places, different barrels are priced in different ways, and it also depends on the differences between sweet and sour grades. For example, there can be local pockets of tightness, because last week we actually saw a strong rally in US Mars sour crude grades against WTI, because I saw something they were saying that refiners could have been seeking to lock in local supply because the Saudis, they raised their OSPs, which means it would be more expensive for US refineries to buy Saudi crude grades. And so there was more demand for local supply. So that led to a rally in the YV, the Mars against WTI differential. So there's still pockets of bullish sentiment out there, which smart traders
bullish physical indications.
Physical indications.
Yeah, okay.
Yeah.
No, that's a fair point. But overall, I think not the most compelling. You get my point. It's not like it's bearish sentiment versus bullish physical. There might be pockets, but the wider physical market indications are not strong at all.
Overall, not strong. But then, if smart traders will be finding pockets of opportunity to express their bullish
that's
views.
about how you that's how you express your trade. So if you're bullish, you would have made money buying the Mars WTI. That makes complete sense. But if we're talking about flat price, which is always a bit of a punt anyway for everyone, then I think I don't even know, you have to have your own kind of view on things. But I think that to link physical supply and demand as being strong and then buying Brent flat price is not the most compelling argument right now, because you're trying to reflect wider global crudes. You see what I mean?
Yeah, definitely. As a reflection of the global oil supply and demand, it's of course it seems to be going into a bearish direction. And actually, I think Goldman Sachs yesterday, on Monday, they lowered their price forecast for the second half from $95 to $86.
Yeah, that was a pretty big deal actually in a way, because I think it was the first time a bank has actually come out and said, we were wrong. What's wrong with being wrong? As in, like, we all got it, like, no one has a crystal ball. You come up with a reasoned argument, and okay, it's not panning out. Okay, let me rethink this. I think I had quite a lot of respect for that headline. A lot of people want to hear about what Goldman's have to say. And they said, well, we're wrong. What do you want? We're not like, if we were right 100% of the time, you think I'd be telling you?
Yeah.
That's just the classic argument to that as well. So I really like that. I didn't read too much into why they said, but they still feel it's going to be a rally, just not as much, right?
Not as much.
Yeah. Because this is another reason why I think we're trying to talk about oil swaps more and other contracts more, because there are a million ways to express a view. But the the retail trader, the institution trader is just thinking, yeah, but you buy or sell Brent futures. So that's one contract. And there's a lot of leverage you can volume and liquidity in 650 plus contracts that are much better for reflecting your view. Like, you've got a bullish view. Okay, you're bullish supply and demand. Why, how, what region? Because you've got all these options available to you. If it is about China, well, why not trade a more Chinese linked contract, like Dubai spreads or something like that? You see what I mean? Were you going to say something, Audrey?
No, sorry. I'm no.
Yeah, no,
I'm
like,
thinking very hard.
No, exactly. So that's why I think it's interesting, our game, but we still need to get these kind of terms. Like Audrey just came out with LST FEI. Like, I know exactly what you mean, obviously, but you know, I've looked at oil swaps for 7 years. 10 years. So it's one of those things where you need to get the wider audience to understand these things or to look at these contracts, which is part of the mission of what we're trying to do, right?
Yeah, and the need for them. Like, I mean, I'm flaking out like LSTFEI, but like at the end of the day, what are we talking about here? We're talking about plastics demand, really. At the end of the day, like what are they going to be used for in the end? It's not like petrochemical demand, which everyone uses plastics all the time. So it's not important to know these things too in the market.
No, but your point is plastic demand, but then there's this niche way to reflect it.
Yeah, exactly. And I mean, plastics are a good reflection of as well, like how well the economy is doing. Obviously, the more plastics you need, your economy is going to be doing well. You've got more retail things going on that way, clothes, all that kind of stuff. It's a good reflection of that. So yeah, I mean, if you're bullish in that kind of way, and you're like, oh, no recession fears here, it's a good contract to look at. Exactly, it's a good thing to trade.
And if you're trading stocks as well, it's either a good hedge or a good further expression.
Yeah.
As you say, but you're being specific about it. So whenever someone gives an argument about the market, if it's not particularly about the Brent futures positioning and flows, then there's a lot of other contracts you can use to express that view. In fact, Brent would probably be the last one I'd choose because it's so driven by financial markets. Anyway, the other thing I want to bring up before you get into your two bits is freight, because you just mentioned it there with LSTFEI. You mentioned it with Brent Dubai. This is the new one this year that's not been talked about. I think it's probably going to start to be talked about more because it is quite common and illogical. When OPEC cut, one thing they're doing is they're cutting their exports, of course. So when they cut their exports, they're in the Middle East, they need to be transported around the world. They're using less tankers, more overhang of tankers, lower freight rates. But if there's lower freight rates, it's easier to export oil into Europe in particular. Because if we're trading Brent and Brent time spreads and we're using that benchmark generically when we talk about oil markets and when people are positioning, like we've just said, you have to know about Europe. And all this is doing is encouraging more and more exports from the US. There's a WAF overhang, West African overhang in crude. That's pointing, as I said, Murban, which is usually pointing to Asia, is now pointing to Europe, or was at least. This is all indicative of low freight, especially in the differentials. The arbitrage differentials is quite a significant factor, right?
Yeah, definitely. I mean, it was one of the key drivers in that LSTFEI ARB last week, because we saw, freight coming off quite aggressively. That was an incentive for people to buy that. So, buy in US, sell in the East. After a time, the ARB just ripped so high and it outpaced the come off in the freight, so the ARB is now shut. But yeah, these are really key. I mean, we saw it last year, with rising water levels when freight couldn't move anymore, and with the Panama Canal delays coming up. I think that was around Christmas time. Those delays, how they pushed up prices and the effects that then has in the wider market. You've got stocks trapped in the East. They can't, they're gonna just go up, or stocks trapped in the US, they can't move east, so then you've got a tighter market. So then you do genuinely have a tighter physical market in the east. So if you want to link your physical and your derivatives, this is definitely one of the key things to look at for sure.
On the extremes especially. I remember a long time ago now, must have been like 2014, 2015, and it was actually gas oil east-west, and the gas oil east-west was getting pummeled down to minus, I think it was minus 30 at the time, because there's the Singapore diesel's changed spec now, but at the time it was 0.5% sulfur versus the diesel in Europe, and that level was the arbitrage was open around minus 25 per metric ton. So when it got there, generally speaking, people loaded up at that level, and then obviously the physical traders could buy it speculatively, and worst case actually move the barrels, and they started, and then there was this big rush to move barrels even over the top of Russia, and use icebreakers and stuff like that. They were coming from all angles to get into Europe. That was previous times when the EFS had been, the East-West had been minus 25 or whatever. But this time it kept going down. And so we're buying it thinking, it's kind of reached its floor. But it turns out freight was so expensive that it doesn't matter. It doesn't matter about the price dislocation, because it's about the price dislocation and the freight. Otherwise the ARB doesn't work. Yeah. And it was just inhibitively expensive. So basically it was it's going to keep going until freight weakens. So it just collapsed and collapsed and collapsed. And it was really weird because there was, as a market maker, taking down this flow, there's no way to get short Singapore gas oil. The only way to get short was to buy the regrade, is to buy the Sing jet versus the Sing, that diff, right? Yeah. And that regrade went to all-time highs. And I was like, jet demand. It's no, it's not jet demand, right? There's the only way to get a short exposure in gas oil is to buy the regrade. Yeah. That was really interesting. But also the EFS, it didn't recover until freight was able to properly sell off and accommodate it. So at its extremes, it can be a missing factor and really, really key. But I think it's really important right now, because if freight's so low and that allows exports into Europe, that's where the overhang is. So as you said, there's tightness maybe in Mars, there might be tightness in Dubai markets, but the Brent market prices to North Sea, and the North Sea overhang is what it is because of so many areas pointing into it. It's only going to get worse with this cut, and when I say worse, I mean cheaper freight, which allows more exports to go into Europe, and this knock-on domino effect. It's probably something the Saudis haven't really thought, OPEC haven't really considered, but from a benchmark point of view, I don't see how, given that WTI Midland is pricing the Brent at the moment, the dated Brent, well, that's exports, so that's just going to keep happening. You see what I'm getting at, right?
Because the freight's going to be cheaper, you're going to be moving. That makes sense.
But if they cut in July, which they have, then all you've said is 13 million barrels of oil is not going to be exported. So that's the tankers that would have taken it, like 15 VLCCs. That's quite a lot of VLCCs, right? That's going to be available for someone to import into Europe. So that's very bearish.
I don't think people have thought about this, actually. I haven't seen this kind of...
Well, at least not... I mean, that's another thing we're trying to do with this, right? Have a bit more insight and dissect headlines into more of the niche understanding and impacts. And it's obviously, we're taking a few liberties here and it's a few knock-ons, but...
It's an interesting component for sure. People will look at east-west differentials, but they'll find that it's just 2 + 2 = 5. Where's the missing one? That's where the freight prices come in. There. No. It's an analogy. People see, doesn't mean make the freight completes the full picture.
Or they'll just assume that one is stable. And if you go 150 or plus 50, it is kind of not irrelevant, but it doesn't have the material difference. When it goes to extremes, that's when it can really mess with the historical ranges. You see what I mean?
Yeah, so that's exactly where the physical component comes in, because of course to move cargoes you gotta pay for the shipping costs and all of that. So I suppose in a sense that is how the physical's linked to the derivatives market.
Well, the physical guys have to hedge that future movement of barrels by buying or selling that differential depending on which leg is leading. And they won't come in and do that hedge if it's not open. So it's kind of it is linked, but it's not. It's still about derivative buying or selling. So it's not like they buy that diff and then suddenly the physical moves. They're buying that so they can hedge their physical movement. So they're not going to do it if the physical movement isn't going to happen. So that lack of buying is what allows the markets to not be supported. But you see what I mean? So it's not a direct physical link. It's still so let's say, for example, and I think this has happened plenty of times, like particularly with the Brent Dubai, it's like you buy the Brent Dubai to hedge your arbitrage west to east. But if it's such an open arbitrage to the extent where it's just a structural change, there's almost no need to hedge it. And actually you would prefer, when you commit to buying in the future Brent price cargoes and delivering it into Dubai price cargo areas, you're like, that's going to give me an implied derivative position of long Brent Dubai. Short Brent Dubai, because I'm buying the Brent and I'm selling into it. But I want that short position because I think it's going to keep going short. So rather than, I'm just not going to hedge it. So even though it's massively open arbitrage, that I'm not even going to hedge it. I'm going to take that on as speculative risk, or just leave the arb open and make more money because I think it's going to keep going that way. So in that way, it's not actually supportive of the differential, because you see what I mean?
Yeah, so not hedging is essentially a view in itself.
100%. And that's the thing about the executed volume versus internal price risk. Like the trade houses and majors have these enormous positions that come from moving their physical around the world. And obviously they're very clever about how they bring that risk together into a view one way or the other. Like if I go back to 2020 in April, when the pricing war happened, of course, there's people shorting flat price spreads, all the rest of it. But remember, it happened on it got announced on a Sunday. So the market gapped down the Sunday night, and it was too late to get short flat price. Or you could get short flat price, but like $15 lower, $10 or $15 lower, and spreads and all that. So one of the clever ways of getting short was essentially leaving all your hedges unhedged, all your physical trades unhedged. So for example, like what would usually happen in deep contango markets is traders will be like, okay, they'll go to their derivative desk and say, I need to buy a bunch of spreads, time spreads to, roll my storage. I'm going to be filling up my land. I'm going to be putting on tankers, go and hedge it for me. And the internal desk could say, do you know what? I'm just going to sell you internally because I want that short exposure, because it's so obvious what's going to happen. In April, it was so obvious.
Yeah.
So rather than go into the market and buy, like, why would I go in the market and buy, hedge this? It's going to massively sell off. It's so obvious. So it was a nice way to get short time spreads. You make money on the physical storage, but you also get a speculative position on. You see what I mean? So you could give the guy the hedge who's doing the storage trade on the physical desk, and as a derivative trader, you're like, I'm taking that as risk, and the market wouldn't know because you've done it internally and you've done it via physical.
Okay.
You see what I mean?
Yeah.
A lot of conviction in this.
Yeah.
And really high conviction times, this is what they'll do. Yeah, that's my point. Yeah, good point. So it's not like you can just expect every time the ARB's open that the ARB
they're going to do this.
It's going to be buying, because they might do the ARB, but actually just not trade it in derivatives. So you won't actually see the impact in the derivative market
on the screen or in the open interest.
It's all about people translating their physical views and actions into derivatives. If they don't, it's at the mercy of just flows still, but then pricing when it gets to it. Yeah. Cool. So
really interesting.
Getting on to what you've been focusing on. So
so I guess I'm going to bring up, can we bring this up on screen? I found this on the internet the other day. This picture, it's an AI generated image, and it won like a photography award this year. So it won a major photography award. This is by a German artist, Boris Eldagassen. His entry, he didn't actually accept the award because he was like, I didn't take this picture, this is an AI generated image. But it just kind of got me thinking, this just goes to show how bad humans are at, telling what is AI generated and what's not. So when you actually do have like a really good look at it, you can see like her fingers are a bit messed up, and there's a part of this image actually missing where you can kind of see her like.
I was going to say the woman on the left's like face is a bit like, it looks like a drawing almost, but the one on the right is very hard to tell.
Yeah, and her sleeve does go into her arm, but it just kind of got me thinking, like, we're really bad, at telling what's AI and what's not, and it's only going to get better. Definitely. So then it kind of brought me to think, everyone should have seen this image. It was that fake explosion at the Pentagon. I think the market reacted at the time, like we saw like S&P 500 drop like 0.3%, which was quite a big drop at the time, and you saw the other kind of safer havens like your gold and your silver, those two went up. I think it wasn't only a couple of hours and the market was like, this is fake news, blah blah blah. But as AI, it kind of got me thinking, as AI gets better, we're giving awards to these fake AI generated images because we can't tell the difference, and as AI gets better and better, it's only going to start getting harder and harder for humans to decipher what's real and what's not. And then I just kind of thought of like all the scenarios that could happen. So for example, like we're just talking about freight. What if you had somebody come along and generate an AI image of, like no water in the Rhine, or, big backlogs at the Panama Canal, to, serve whatever purpose they wanted to get done in the market. And then also, like, who reacts to this? So, I mean, like I mentioned, we were at eWorld a couple of weeks ago, and, algo trading in the power market is really, really big. But obviously, like, the way that's traded at the moment, it's traded kind of in, like, 48 half-hour segments, and it's all about, like, trying to balance that grid. So AI in that kind of situation is quite useful. But in terms of, like, the oil markets, it's like these algorithms are designed so that they react to headlines in the news. That's how they're kind of... That's how they're designed to work. So I just kind of wanted to get everyone's
that's
thoughts
super
on
interesting.
this.
I was just thinking, it's like the algos are the ones reacting, or the AI is reacting to AI.
Yeah, exactly.
So spoofing. Even
though like you think that the AI would be better at discerning what is AI and what's not, but the problem is, so you're going to see, you see an explosion at the Pentagon, someone at one of the big like research houses is immediately going to see that image, write a headline post.
Well, they're going to go and investigate though. That's the difference, right? So the physical trade houses, the majors, the research houses, they're going to pick up the phone. It's the first thing they're going to do and
find out, is this real, is this not real? But your algo is going to just take the headline and just go like bang and execute a trade.
That's super interesting.
And these are obviously now, I guess when the headlines come out later in the afternoon that this is fake news, the algo should in theory like correct itself back. But as like algo trading gets bigger and bigger, and the more of it's there, so at the moment it's probably not as big an issue because you have like these algos doing like this high frequency trading, and they don't have as much like capital as like these lower frequency. No, but
there's like algorithmic automated trading that reacts to NLP as well, or the language programming.
Yeah.
So they'll read a headline for you and assimilate it as bullish or bearish.
Yeah, and then they'll just do whatever they want to.
Yeah. So a fake headline comes out, a fake picture comes out, they're going to react to it.
Yeah.
But then it's like, that's a great way to actually reduce the impact of headlines having an impact on the market, because people are going to slow down and check these things.
Yeah, and that's the bigger money then, isn't it? So you've got like your lower frequency trades, like your hedge your hedge funds.
So in a weird way, this is the first time I've ever thought about this from what you said.
It's
does that not actually price out automated trading in a way, or at least reactions?
Yeah, as in the people that are probably going to be better at reacting to this are going to be the AI, or
no, I don't know.
I was going to say, but they'll correct themselves again in the evening. So like, say a really bullish headline comes out in the morning and it comes out as fake news in the evening, they're going to correct themselves.
So then the AI needs to learn, but it needs to learn the same way we would
to not react
to So how do you decipher whether something's...
I don't know.
But as an AI gets better, it's harder for everyone to assimilate. But real things happening still needs to come from humans, right?
Yeah.
If the White House gets blown up, you need an official statement from the White House.
From the White House. Are you like? I mean, have you seen that image of like Donald Trump getting arrested?
But see, I've got to say, when I've seen these things, I don't immediately think that's true. If anything, I immediately think, well, it'd be bigger news than this. There'd be people writing about
the Pope in his puffer jacket.
Well, yeah. But like, this is what I thought about with, when OPEC leak or people leak things to the press.
Yeah.
Like, the press have a process. They're not just gonna. If I just call up right now the Wall Street Journal and say, oh, I've heard, this is going to happen, they're going to increase production, they're not going to go, oh, thanks, and just write an article on it.
Yeah.
They're not going to do that, right? They're going to verify their sources. I was even watching that Snowden film on the weekend. You know Edward Snowden, guy, the whistleblower in the US.
Maybe.
You don't know.
Is he the... yes, actually. Did he go on the run?
Yeah, he's in Russia, actually.
Yeah, because... I do actually know the story.
Yeah, so he was just... like too much Big Brother activity, you felt, and then he released all these files.
Yes, I do know this guy, yeah.
Jesus, lost my train of thought. The point is... I actually don't know what my point is. What the fuck was I saying? I have to go back. What did you say before that?
Your sources.
Roger. Yeah. Okay, I'll start from this.
Some input,
Yeah, so in the film or in real life, the initial process is convincing the Guardian, like, who is this guy? Does he actually have the access? Like, you're not just going to release like some devastating article for the whole world just because someone said it. Like, it needs to be highly verified.
Yeah.
So I don't know, that's quite comforting for me. Like, the more that AI tries to take on like headlines and disseminating videos and photography, the more it's manipulatable, and actually by definition people will be more skeptical about it. So if anything, it's like, I think I said this on a podcast a while back, like, one thing that drives you nuts when you're trading futures is the algorithms who are like have a faster connection to the exchange than you. So if you put an order, they react faster, and it's just bad execution, and you feel like they're always like, you're always like second best for your execution. So what people have done in the past, and it's illegal ironically, is when people, they call it spoofing, right? So you'll put like a stop loss in, or you put like a big order in and you'll cancel it, and the algorithms will react to it, but then you've cancelled your order, so you don't actually trade, but the algorithms reacted. And for some reason that's illegal, even though the algorithms are the ones that doing the actual front running. But either way, it's a reaction against it. So the reaction against AI is like, well, I'm not going to take this at face value.
Yeah, I think a lot of people in this market anyway, as in just from anyone I've ever talked to, is very averse to algo trading. Like, it's very much like an annoyance of people. And this was something that I talked about with people in the power market. So obviously they're traded in completely separate ways, but actually one of the companies we were speaking to, and they were chatting to us about like how eventually the future of this isn't going to be that it's going to be a trader at the desk. It's going to be the trader's function is going to be to program their AI, to program their algorithm to do whatever they want, like stop at this level or do this. But is
that not the same thing though? It's just about execution.
It was a randomization function of it as well. They had this randomization function. Is that making sense? Yeah. That function, I found that really interesting. So in that way, I mean, you could train it to not react to every headline, react to every third headline. I wonder, could you do that?
Yeah. But surely what it becomes is just like a democratization of automated responses to headlines, and you actually have to go in and check it yourself. Yeah. Otherwise, we wouldn't need journalists. Yeah. Journalists have to vet these things. Yeah. So if it comes out from Bloomberg, though, to be fair, you assume it's going to be correct. So actually, that's key, isn't it? That
explosion as well.
Did that come out on Bloomberg?
No. But it came out in some like pretty kind of reliable sources' Twitter pages. I know this is saying Twitter, but still, people look at Twitter like all the time, and there's some really good, like really.
Also, it's good for reputable journalists.
Yeah. I see some really good like news.
No, I'm saying is in like to my point about the algorithmic stuff. They will still be able to react to headlines coming from reputable sources because they would have done the vetting.
Yes,
so it's not as comforting as I originally thought.
But then it's like I said, I mean, you have this this is like such a segment, but I was listening to a Joe Rogan podcast the other day. I can't remember who it was, but these two guys basically anyway started just absolutely spoofing these papers to get on the nerves of like the woke community, and they got like 7 of them published by just spoofing this. Like they just made up all these facts that they knew the woke community wanted to hear. They've all been retracted since, but they like the fact like humans are bad sometimes. Even like people that are supposed to be good at fact checking are bad sometimes at this. So like, and as this AI gets better, it's going to be harder for those reliable sources to fact check it as well.
I think also with fact checking is like different people, different organizations, governments, they have their own narratives. So there's a lot of bias here, and of course in this era of technology, a lot of misinformation, a lot of propaganda going around, and yeah, it's just a big issue that the world has to deal with for the next few decades to come. But I thought it was interesting because I was just going back to Audrey's point. The market seems to be so adverse, the oil market to algo trading, specifically the oil swaps market, that most of the trading is still done over the counter through with brokers. Like it's still very much voice brokered, so it's still sort of old school. That's very interesting. But back in the day, information is king, right? Especially with the commodities trade, looking at supply and demand. If you had access to the supply chain, you sort of had more information that you could be working with to, of course, optimize your trading strategies. It's also really exemplified in the film. I think Wall Street came out over 35 years ago. Have you guys seen that, featuring Gordon Gekko? Very one of the top
if
villains.
anyone hasn't seen that film in finance, I'd be shocked. You're like a tiny minority.
I'm gonna go on the plane and watch it tonight.
Have you not?
No.
The insider trading.
You're a scientist, so that's why. Go on.
Yeah. So of course the film was about insider trading, and of course that's very much, it's heavily regulated around here. It's very much illegal for good reason,
but not in the oil market.
But there's still regulations surrounding that, of course, right? Because all of the trading we do, it's
on the financial market, there's regulation on like execution and things like that, but there's no regulation in the physical market. That's like a contentious thing, right? It's very hard to regulate.
It's hard to regulate, so that's why people still want an information edge to help them. And perhaps on one hand, people might see these headlines, they think, oh, that's information other people won't be seeing. Or, as I mentioned before, with people having their agendas and narratives, you could just pump the market, spoof the market with a particular headline to gain a particular reaction. And of course, that has a knock-on effect on prices should the market react, because even though the S&P might have fell only by 0.3%, but if you have millions and millions in it, then that could still be a substantial loss as well, because that's, even if you have 100 million and then falls by 0.3%, that's still 300k money, $300k in the red as well. So I think there's just very, very interesting dynamic that will be interesting.
Yeah, I just hadn't thought so much about the spoofing angle before in terms of like the evolution of spoofing. But I think you'd mentioned this not long ago about like, it's a game of tit for tat, right? So originally, people are not so accepting of financial flows driving markets again, that theme. So the people who were aware of how to influence the financial market using headlines would do so. But now that people are aware that they do that, it's a different game, right? So the recent game with like the Saudis and others like releasing headlines into market and they're not reacting, right? Or they are reacting. So I think what it's about now is not that has gone away, even though people know that you're leaking things purposely. It's doing it. It's a poker game. It's doing it at the right time with the right cards. So if you come out and say, I'm cutting, it's like, like you said that so many times, it's like, it's not even a bluff, but it's just stuff we know. Whereas on the flip side, this headline comes out like every so often periodically,
bearish.
It comes out again, but the market sells off like $2. It's like, well, it's not even a verified. White House come out and deny it completely, going, what are you talking about? We haven't agreed anything with the nuclear deal. In fact, it's the opposite. Like, there's rising tension. But the point is that the market clearly wanted to sell off, or the market was nervy on the long side, as in bullish people being like, should I be getting out of my trade? I see a headline of Iran, bosh, I'm going to sell. Or sellers getting more confident, or whatever it is. But the point is that headline, that card in poker, how you use it is the important thing. There's no point wasting a bearish headline, or even a bullish headline in a market that doesn't want to rally. In other words, it's too long already, or sellers are kind of ignoring bullish facts. If that's the state of the market, then don't use the card. Use the card at the right time. You should. I think that's what it's evolving to. And again, I think even without like artificial intelligence,
can you imagine like an image comes out and you've got like White House officials and Iranian officials in a room together, just an AI generated image, and then you have like this market chatter of, they're all in talks, like that could,
if the market wanted to
sell off, then
hear these things, that could be a great impact. I agree.
Like this is how it can be used. And it's just really, really interesting, and just how bad humans are at telling the difference versus, maybe AI is better, but they're reacting to the headlines, not the image. So if it's humans writing the headlines,
it's us getting comfortable with working alongside machines.
I mean, I do love a bit of ChatGPT, but it's wrong a lot too.
It's an it now.
It's an it now. I've been calling it she for anyone listening because it was a woman's idea in the anyway. It's a machine. I shouldn't be giving it a gender. But it's been wrong. So I've been like fact checking, like just checking my own work, and I'll be like, do you know what this means? And it gives me wrong information. I'm like,
what's a language model? It's not like a copywriter. It's not. It's
pulling stuff from the internet. I used to have a professor in university, and I was studying genetics at the time, so there's obviously very clear science in the back of that. And he used to go on to Wikipedia, and he would edit the Wikipedia page to give it false information, so he'd know. When it came to an exam, what students just went away and Wikipedia'd stuff instead of going to the library. Like, it was so nuanced. It was like, he was like, you have to go and you have to get out the textbook because it's not on the internet. And he would know who would just go on to Wikipedia, and he'd just automatically fail them. But ChatGPT, if I'm looking up something from genetics, is going to go and find his false information on Wikipedia.
But reading market headlines and reading things is the human element. So until like we can consider it as a conscious thing. But also it's the medium. So like, a computer, like people are saying, they could replace a trader, and you could get brokerage information through chat. You could get, even if the brokerages talk, that gets downloaded into transcripts, which can then get passed to machine learning, which can read it. That's fine. But how does the machine learning algorithm actually go out and find the information other than data sources? So for example, is this real? Like, has there actually been an impact? I need to go speak to a physical trader. It could automate a general question to a physical trader, but again, why would they answer like a written thing? Like, it's a human relationship, it's a visual thing, or unless the algorithm has like automatic links into satellites and visual thing, how is it meant to get that information? Surely we're a while away until it can do that better than humans. So the verification element is becoming more and more. But it's a great topic. I think we'll keep talking about this. I think it'd be really interesting
if to get people that use algorithms to trade as well, like their opinion on this.
Well, I would like that. That's one thing I would say is that, like, the one thing I've learned lately is people love talking about algorithms as if like they're driving markets, and oh my god, I can't control a computer. Look, the CTAs, like I don't know why they call it CTAs, Commodity Trading Association. What I mean by CTAs is trend following systems. They haven't made money for years. It's not a good strategy at the moment, and they're trying to pick a trend, and they're getting burnt by volatility because they can only rely on historical data. There's new volatility regimes. It's just not going well for CTAs. So they are trading a lot, but they're not making money. So by definition, they're just adding liquidity. They're not actually driving markets. So I don't know, there's big fear of CTAs, and if there's a bearish headline and it moves down and it's exacerbated by a CTA, it is exacerbated by a CTA, but then equally it rebounds very quickly and the CTA has to stop out and it gets exaggerated the other way as well. So it's like a bit like over fear about CTAs and algorithms in the market. I don't actually see high performing algorithms in this market. Definitely not the oil swaps market. People are, you must have an algorithm behind what you're doing and then you execute on the screen. Like, no, I'm not. Like, no, we're not doing that. Like, genuinely, no, we're not doing that. So I don't know. That's just one thing I wanted to add. But we have talked that to death. So, Vincent, what about your stuff that you were going to bring up?
I believe we've pretty much covered a lot of bases. So it can all be related to OPEC. I was more talking about how prices reacted this week and a little bit in the past week, but also a little bit about the wondering about the history of OPEC as well, because often in the past they have had a big influence on the market, but it seems like that is slowly waning little by little. So it seems to me that there's, including us, there seems to be more of a view from other people that OPEC is almost losing its credibility by what they've been doing over the past year, as in talking about production cuts, bring stability to the market, yet they haven't reached the goal that they have set out to achieve. So it's, and then people also talk about, there's such a big disconnection between how the physical market and how the futures market is doing. We've already talked about that, but what I'm trying to say is, what should OPEC have done? Should they just have not done anything, or maybe this was one of the few chances left to actually take back control of the market?
Brexit slogan.
Take back
Brexit.
control.
Yeah.
Make OPEC great again.
Yeah. Good. No, I was thinking, I've been saying this in the reports quite a lot. No, like I think in these scenarios you have to understand like when to use your card, and it's a powerful card, but you can't keep using it when it's clearly the market doesn't want to respond to it. The physical market's not reacting unless you go nuclear, right, and go, right, we're producing like half of what we do, but then you're kind of hurting yourself unless you really do think things can follow through. So my belief is that if you prop anything up, even like QE macro markets, central banks are trying to, or at least were trying to, force a recession, because that was the only way to get out of this, unwind things, monetary easing, and you do that for the long-term good, right? People can consolidate, you can get debt to be eroded by inflation, things like that, right? Like then the economy can be bullish in the long run. I think it's the same thing in oil. You're going to keep propping it up, and there's all these attempts to keep propping up. It's very expensive for derivative traders to keep buying in these cut announcements, then losing money and having to stop out, or keep buying, pricing contracts and buying physical barrels because they think they're going to be well in demand, and yet the pricing goes weaker. Like that just gets expensive after a while, and that's why I love looking at the Brent expiry, because it's that time spread is indicative of physical differentials of what the actual health is. Negative, it's weak. Positive, it's strong. Simple as that. And I think the recent Brent expiry was negative. It looks like it's going to go negative again. And I know it can be slightly distorted, and it is 2 months forward, so it's a bit speculative in its own right, but it is a real physical signal. And I think the more and more the spread fails to perform into expiry, the more people it's going to go, do you know what, I've had enough. Like it's just not going this way. It's just got a short. So if it's going to happen, let it happen. Let it just reset wherever that level is, and when it resets, you can have the relief of lower notional prices lead to end user demand. China demand can actually happen. Inflation eases, the economy gets back on track. Then there is actually a bullish story that can take us, say, let's go down to 50, back up to 70 and beyond. That can happen because you've allowed it to reset and consolidate. That's my personal belief in answer to your question. Because when have you ever seen the oil market be steady for a time period? I can think of 2 times in my whole career, and it's maximum might be like 3 months. You need to allow the boom and the bust, and to accept that you're propping it up. Just let it go, let things consolidate and go again. That's my belief.
I suppose your point is that the Brent expiry is great in facilitating this price discovery, because it's the futures is truly linked to the actual physical,
and it's in the future. So it's August barrels coming up now. We're only in June. By the end of June, we'll be trading the expiry, which will be for people to take on August barrels. So they've got to take a view on the physical. So it's a futures market for physical, right? But it's really good indication whether people want to do that or not. So to give another example, like when I was, must have been 2016, early 2016, or late 2015 actually. We've been in a kind of a bearish regime for a while, since like 2014, and for that year. But it takes a while sometimes, like the market gets bid up again, people start believing it. But then it felt propped up. Sorry, no, it was beginning at the end of 2016, sorry. And what happened was the expiries kept doing this. Like there's this propped up nature, and the expiry was rolling down weak. So the flies were rolling down weak, right? So the front spread would get weak into expiry. The rest of the spreads would hold up, and then it would kind of keep rolling down that way. And the market was long, so it was obviously, and eventually just one day, it was almost like the collective market just went, right, this is just getting bullshit. And everyone the spreads just completely reversed, and it was non-stop selling of like every single spread, or like 6 months forward spreads just getting sold off like 30-40 cents a piece. And it just kept going for like a week, because it was almost like the market decided, this is getting silly now. We know what the real state is, and everything I'm doing right now is like in denial of that. And I think we've got a little bit of that right now. So it's not to say they don't have control. They don't have control right now, and they've used all that they can use. They haven't married up their cards with the right hand.
Timing,
Yeah.
It's just not the right timing, or as a lot of traders like to. I've heard trader jargon about certain participants having certain like bullets they can use, and then I suppose this time OPEC might be using the bullet at the wrong time.
And by the way, this is everything. This is like, we all do it in all our lives, relationships, but like politics, when they come up with the right headline. Like, don't know if you guys watched Succession. There was like these guys in markets, right? They have their they're talking about publicly traded companies, and one company is like, spoiler alert, I guess, a little bit. But I won't use the names then. But the point is that he's like, has really bad information about his company that he has to release to market, and it's going to be really bearish for the stock. And it's like, don't release it like until there's a time to release it. In other words, so on the day of the funeral, where all the attention's on the funeral, it's like, yeah, release it now, no one's going to care. And the market didn't sell the stock because no one's paying attention. And that's key, right?
Well, that's also why it was on the initial production cut during April did take the market by surprise. It was done on a Sunday.
That's an old tactic though. So they realized that tactic. I mean, that the pricing war was the big one. Right. Sunday pricing war, gaps down, and I'm not sure they thought about it, but after that, it's like, wow, we get a $10 reaction in a second, compared with having to watch the market trade up to that point or down to that point if it was in the open market. So now they've overused that card as well.
Because I think when it was planned for a Sunday as well, everyone was like, oh, we know.
It's the same old trick.
Yeah. But also very interesting that the energy minister always likes to target their speculators, as they say, but he's specifically referring to the shorts. Of course, if the market, if those same speculators turn bullish, he won't be complaining. So it's quite amusing.
CFTC chairman, like 40 years ago, said exactly that. He went out and like people against or for the derivative market. He said the producers invariably blamed low prices on speculators and high prices on demand. And then the other side of the coin, end users blamed speculators for high prices. And I can't remember what the reason was for the downside, but the point is that, yeah, of course, like, yeah. And actually what he also said was, if you look at the onion market where derivatives were created and they were banned, before they were banned and after they were banned, the volatility was more than when derivatives were allowed.
Yeah.
Wow. So, I mean, it's just up for interpretation, but I completely agree. It's just all sentiment and rhetoric. And I just think, generally speaking, the world is going this way, right? It's just like, I just don't care what politicians and what policymakers say. I want to see what you do, and I want the numbers, and I'll decide. Thanks. So that's a nice way to end.
Yeah.
Thanks everyone for listening, and we'll be back next week for more of the same. Thanks again. You want to say bye?
Thank you.
Thank you.